Welcome back to our intermediate financial accounting class. In the last few segments, we've been talking about cash flows. We've talked about why they're important, what FASB's goals are with the cash flows, who uses them, why they're used, and then we talked about the new, accurate, actual method for creating a statement of cash flows as opposed to the simplified version that we've done in the past. And using this new, actual method, we've been walking through an example of building a statement of cash flows for Avery Arrowheads Incorporated. And so far, we've finished 3 of the 8 steps. We've gotten the total change in cash as a plug figure, we've created our worksheets, and we've filled out a lot of the worksheets as we walk through the specialized transactions that occurred during the period. The transactions that I made note of, knowing that I would need to account for them in my statement of cash flows. Now that we're done with that, it's time to move on to step 4 and start dealing with the non-cash effects of our income statement. Let's get started. Now for this step, we need to start with our income statement. We're going to go through these income statement numbers and we're going to remove everything that's non-cash. So let's see here. Sales has a cash component because I'm actually making sales to people and they're paying me for it. The equity method I already took care of. I've made that adjustment already, so I don't have to worry about that. Realized gain on investments. That's going to be non-cash. How do I know? Because a realized gain means I actually sold some stock. And the cash effect of selling that stock is down in investing activities. As a matter of fact, you can see it right here. Cash received from sale of securities. So there's the actual cash effect. If I have the actual cash effect in investing, then the gain is not cash. It's an accounting accrual that shows the difference between what I paid originally and what I got now. It's not the cash effect, it's the difference between old and new. And since it's not a cash effect, I need to remove it before I make a statement of cash flows. So I'm going to do that here. This is gain on investments, and I'm going to simply remove it. And when I add these together, again, I take the number here in my accruals column plus the change in cash to get to my cash flow from operations numbers. Positive 53 plus a negative 53 is going to get me to 0. The other thing I'm going to do is I'm going to mark this in a different color. Let's make it purple. I'm going to mark it in purple because if I get to the end of step 7 and it doesn't balance, then I know that I need to fix something, and it's easier to fix things if I know what step they relate to. So we did all of step 3 in red. I'm going to do all of step 4 in purple, or of course whatever color you want to choose. But I'm going to color code it by step just in case something goes wrong. All right, so that takes care of the gain on investments. Interest and dividend revenue could have a cash effect, so we'll leave that there. Cost of goods sold will probably have a cash effect. We'll leave that there. Salaries will definitely have some cash that I paid to my employees. Pensions I've already taken care of. Operating expenses will have some cash flows. Bad debt expense. Bad debt expense itself is not a cash flow. The cash flow comes when I receive cash from customers. Bad debt expense are the people who I think might rip me off later, but there's no cash there. So I need to get that taken care of. If you remember, we combined sales and bad debt expense at the very beginning when we created our worksheet, because we knew all of these pieces, the sales and the bad debt expense and the change in accounts receivable, were all going to work together to give me one number for my cash received from customers. So the best way to get rid of this bad debt expense effect is to go ahead and adjust for cash received from customers. Now, how do I do that? Well, I look at net accounts receivable. Net accounts receivable includes what I think I'm still going to collect and the allowance for bad debt that I think I won't. And if I use those numbers versus the bad debt expense and the sales revenue, all of those balances together get me to what I actually received from my customers. So let's take a look at our balance sheet. We have one line item for accounts receivable. Since there's only one line item, by default, it must be net. And our accounts receivable has gone from 1.9 million to 1,947,000. So accounts receivable goes up by 47,000. If an asset goes up, cash flow goes down. That's that teeter-totter that we used way back when. And I'm going to stop right here. We talked about how, we don't want to use the simple version anymore. You're right. We don't want to use the simple version. We're going to dig deep and look at specific transactions. We're going to dig deep and look at our income statement and make adjustments there. Then we're still going to look at balance sheet effects. And we're still going to use those methods, the teeter-totter and the wave, we're just not going to solely use them and assume that accounts for everything. That's the difference. But I can still use the basic method to help me out here. So again, if accounts receivable goes up by 47, cash goes down, and that's the adjustment that I'm going to make in my cash flow from operations line. And I'm going to do it right here. Change in accounts receivable net. We said it was a negative 47,000. I'm going to mark it in purple because it's part of my step 4. When we get to step 6 and we complete the worksheet, we'll take the 6,555,000 plus that negative 47, and that will give me cash received from customers. In that one, I'll take care of the sales revenue, the bad debt expense, the change in accounts receivable, the change in allowance for bad debt, and all of that together will work out to give me this number. But please make a note to yourself, highlight it, circle it. I use change in accounts receivable net, not just change in accounts receivable, or it's not going to give me the right effect. We just lucked out in this case that the company had already netted those out for us, so it was already done. Okay, let's see. We've done bad debt expense. Now we've got depreciation and amortization. Both of those have nothing to do with cash. Depreciation and amortization keep track of our use of assets that we purchased in the past. As we use it to make revenue in various periods after we bought it, we allocate some of the cost to those periods. That's what depreciation is for. But there's no cash there. The cash happened back when we bought it. Matter of fact, we can see an example of this down in our investing activities. There's the cash paid for PP&E, and there's a sale of PP&E. That's the cash effect. So there's no cash from amortization. So I just want to get those out of there. We normally label them something clever like depreciation and amortization. And I'm just going to cancel them out. So I'm going to do the exact opposite of whatever is in that account. And then when I take negative 757 plus the positive 757, it'll go away. Let's see now. There are still 2 more here. The one obvious one, we got rid of the gain on sale of marketable securities. We also need to get rid of the loss on sale. Cancel that out. And again, you can see down here, there's the sale of equipment. The actual cash is down here for 59,000. I can't have the actual cash down here and a loss up there. It double counts. So I've got to get rid of the loss so I can use the actual cash down below. The other adjustment is for what we call accretion expense. Now, accretion expense is probably an expense you haven't seen before. You might have, but for many students, it's the first time they've seen it. Accretion expense is amortizing away the discount on an asset retirement obligation. And I'm going to scroll down here just a bit, give myself some room. When we first get an asset retirement obligation, we have an obligation to pay a certain amount of money, let's say $100,000, at the end of however many years when we're finished with the asset and we're going to clean it up. But I don't record it at $100,000. $100,000 in the future may only be worth $70,000 in today dollars. So I record it today at $70,000, and then over the life of the asset, I record interest expense and amortize away the $30,000 present value. That's accretion expense. It's all these little steps that allow me to amortize away that $30,000 difference. Well, there's no cash there in accretion expense because the cash isn't going to go out until I actually pay the $100,000 in 10 years, 5 years, 8 years, however many years it is, until I have to clean things up. So like any other amortization, that accretion is a non-cash number. It's a necessary accrual number, but it has no cash effect. So I just need to cancel it out. But just like I did with all of the other amortization and depreciation, I'm just going to get rid of it. Last thing I need to do, I've made 4 changes. I need to get them marked. Step number 4, again, we're just going to go through the income statement. We're going to find anything and everything that's non-cash. And hopefully you noticed a pattern here. We had that change in accounts receivable net, and everything else was either depreciation, amortization, gains, or losses. Those are the primary accounts that we're looking for that are going to need to be canceled out as non-cash items. So 99.9% of the time, you'll need to cancel out gains and losses, and 100% of the time, you'll need to get rid of amortization and depreciation because those are always accrual accounts, not the cash paid for the actual asset. So we definitely have to get rid of those. Most of the time, we get rid of the gains and losses. So that's what we're looking for as a shortcut: gains and losses, depreciation, amortization. And we could say that's another of our key concepts. When we come back, we'll move on to step 5. This is where we mop things up, clean things up, make sure we've captured everything we need to so that we have all of the cash flow information ready to go to build our statement of cash flow. We'll see you then. Thanks.